Hi, everyone. I'm James Garbutt.
And I'm Denny Dumas.
And this is the Garbutt Dumas Real Estate Podcast. What you need to know about financing in today's market. Well, Denny, where do we begin with this one? I think it's important that we just refresh people's memories or just provide information about financing today. You know, when you're buying a home in this action-packed market where multiple offers are fairly common, you're making rush decisions with lots of money in a high-rate world, and you need a bank to finance that. So what do people need to know?
It's changed dramatically in the last 18 months. If you look at January to April of 2022, a typical mortgage rate was 2%, 2.5%. The stress test was calculated on the greater of your contract rate plus 2 or the benchmark rate, which is 5.25. So in an environment where rates are in that 2 to 3% range, you are stress testing on 5.25%. In today's environment, when a 5.5 rate is very common, you are now stress testing on 7.5. So that's roughly a 2.5% difference on the stress test, which means your purchasing power has gone down pretty significantly in that like 25 to 30% range comparatively to a year and a half ago. Have market values gone down 25 to 30%? Don't think so. Definitely not. We're doing another podcast. The next one is comparing market values from 2016 to COVID to today. So we will share through that, but they're definitely not down 25 to 30%. So I think just the whole landscape of getting approved and what you get approved for looks very, very different comparatively.
You know, the purchasing power, the lending ability is down
25-ish percent.
25-ish percent.
Yeah.
I think the interesting there is it kind of just shows the stickiness of the market. Mm. You know, when something happens that reduces, like prices go up quicker than they go down often. Now, there might be a few exceptions in there, but maybe the fall of 2008 might be one of them. But in general, they're a little bit stickier to come down. When your borrowing power, we haven't seen prices go down 25%, even if someone can get 25% less of a mortgage. But what I will say is we've had a lot of upward trending moments in the market over the last decade. And when lending goes the other direction and your borrowing power goes up 20%, what you tend to find often is that if you're looking at a first-time home buyer, that's a pretty good example. If a typical first-time home buyer's lending goes up 20%, and you look at the products they buy, maybe it's a one-bedroom in Yaletown or whatever. I mean, that's an expensive first-time purchase, but reasonable for many. They tend to go up by the increase in the lending ability over maybe a 6 to 12 or 18-month period. But when you make lending more affordable and people's lending loans go up, you start seeing the market prices kind of go up at the same time with them, or lag a little bit behind. But when they take away that lending from you and they go down, well, right now we're seeing the prices hold. So it's just kind of an interesting relationship. You give people more money, prices go up. You take away their money, they hold for a bit because of the lack of supply. And we'll see if they go down. Maybe they will in the winter. But I would be shocked if prices went down 10 or 20%.
Should we talk about rates?
Yeah.
A typical variable right now. So remember, variable works off the prime rate. The prime rate now, as of June 7th, is 6.95%. And banks have got tighter with their discounts. So in 2020, 2021, it was fairly common to see a discount of 1%, 1.1%. And on the high end, so the least amount of discount, Scotiabank right now is anywhere from plus, so prime plus 0.05%, to about minus 0.1. That's kind of the very, very low end. TD and HSBC are offering roughly prime minus 0.7 right now. So that's actually much better than it was even 6 months ago. In the fall of last year, I remember seeing like a good discount at minus 0.3.
Yeah.
So we're seeing some banks start to loosen up that discount as Prime's going up. Well, as Prime went up again, but TD, HSBC are leading the charge right now in the variable world of minus 0.7. Typical 5-year fixed rate. If you have an insured mortgage, which means you're putting less than 20% down, you typically get a better fixed rate, and that is just over 5%. That was down, like Jamie mentioned, into the mid fours, 4.6, 4.7 kind of range, but that now will be about 5.1.
It feels like it's gone up 0.5%.
About 0.5%.
In like a month or 6 weeks or so.
Yeah. And if you are taking a conventional 5-year fix, which means you're 20% or more down, that rate is looking in the range of 5.6, 5.7 right now.
Oh, jeez. You know, there's a lot of talk over the last decade about, variable always wins. And right now, variable is not like, we're in one of those moments where we're in the exception. And people in variable rate mortgages that didn't lock in a fix prior to this rate hike are feeling it right now. But right now, is a 5-year fix the right move? Is it a 2-year or 3-year? Those are the conversations I'm having. It's not about, I think some people are just biting the bullet and going for the 5-year, but I'm having more conversations about 2 and 3-year fixed mortgages with the anticipation that pay a high interest rate for 2 to 3 years, and then you're going to have much better options after. Unknown. At the end of the day, your mortgage payment is higher, your interest is higher, but the price you pay for a property today should be much lower than it will be when you wait for them to get lower. And I think the savings is going to work out in your favor over the long term.
Speaking of a mortgage payment, on that insured mortgage, let's say 5-year fix, just over 5%, you're looking at about $583 per $100,000 borrowed money. Versus a conventional mortgage where your rate is in that 5.6 range, you're going to be over $600. It's going to be about $620 a month per $100,000.
Per $100,000 mortgage. Yeah. I listened to something at a 5.5% mortgage rate. If you get a $1 million mortgage at 5.5% over the term with a 30-year amortization, over the term of that mortgage, you're paying $1 million mortgage, 5.5%. Over the term of that mortgage, you're paying $1.03 million in interest. So you're paying just over the balance in interest. In the first 5 years, 77% of your payments are going to interest. So in the first 5 years on a $1 million mortgage at 5.5%, that's $262,000 going into interest, and then $72,000 paying down your principal. A lot of interest, but you're using bank money. I openly, Denny, like the rate right now, you mentioned 5-year fix being in the low fives. Where do you see that being? And this is where we shouldn't be overly predicting, but how high do you think it's going to get higher? Or do you think this is the peak of it? What's the temperature? If you were to have your crystal ball right now?
You're setting me up for failure.
Yeah. Let's put that crystal ball out there. It can go either way.
My guess now is that there's going to be one more 0.25% rate hike towards the end of 2023. My guess is that 5-year fixed rate will peak in the 5.8, 5.9 range. I think we'll see a couple basis points increase through the next 6 months, and then 2024 it'll start to come down. That's my guess.
I think we could see, and this is again wild predictions here, but I agree with you. It could go up 0.2 to 0.4% in the short term, maybe more if it's high fives. I think they'll start coming back at the end of this year. I liked before, maybe not the overnight rate or the prime rate, but the 5-year fixed, the fixed rates. I could see them start coming down. I was pretty surprised I didn't expect another 5.5% increase over the last 30 days. Probably could go backwards at the tail end of this year. When they see the data of slow sales in August, September, October, might start working its way through.
One can only hope, Jamie.
How do we go into some of the financing things people should know when they're buying a home, like a pre-approval versus an approval? There's the important thing I think to know is the amount of risk you're putting on that purchase, that offer, especially if you don't have a subject to financing. I mean, just on that note, it's always important to start with a pre-approval. So when you're going to buy a home, whether you're looking anxiously and ready to offer any minute, or whether you're just opportunistically looking and there might be one home a year that you want to purchase, the perk of a pre-approval is you know exactly how much you have to work with, and typically it comes with a rate hold for 120 days. So right now in this market in June, if you had that rate hold, you'd be thanking yourself, because the rate hold you'd have is cheaper than the market rates available. But it's a pre-approval. It's important to know it's not a guarantee of money. So even if I had a pre-approval today where I could get pre-approved up to $1 million to buy a property, it's a conditional approval. It means it still relies on my income and down payment to be there. So my income, it might be subject to confirming my income before the funds are issued. I need to prove my down payment funds, and they need to appraise the property. So, if you get a pre-approval, just recognize that a pre-approval versus a firm approval are two very different things. Pre-approval, bank has outs. Bank can pull that money out. A firm approval is when you just have an unconditional approval where they've appraised the property, they have all your income statements, they have your employment confirmation, and they are good. But even then, there can be some scares at completion if things happen.
Pre-approval is always going to be conditioned by approving the property. So if you don't have an accepted offer, or if you're a few months away from writing offers, the bank is going to ask to see a property disclosure statement from that property. They're going to want to see the contract. They're going to want to do an appraisal. If you're paying $2 million for a home that they appraise at $1.5 million, guess what? That pre-approval doesn't mean that much. They're going to lend on 1.5, not 2 million. So that's really the big difference is pre-approval. They're basically approving you as a financially capable human that you can afford up to a certain amount of money based on your income and debt, et cetera. And then the firm approval comes into play when you have an accepted offer on a property. Then they are conditionally approving the property.
Yeah, I mean, just talking about the property, items that can affect an approval. I mean, if you're buying a house, if it had a grow up, that affects some lenders. Some lenders won't lend on a grow up. It's unfortunate that's still the case, because if you have a grow up, it's got to be remediated and you got to go through city inspections, and the house is usually pretty good after that. Maybe that will change. A house could be in poor condition. Like if a house is old and falling apart, they might deem the lifespan of a home to be another 15 years. And if you're trying to get an amortization of 25 or 30, they're not going to give that to you. So it will either affect the payment because they'll give you a lower amortization, or they may not allow you to buy with 20% down. You might need 35% or more.
This is a really big one on older single family in Greater Vancouver, and also a good idea as a realtor, if you are a listing agent, a buyer's agent, to show up to the appraisal, to educate the appraiser on how many people came through, that it got multiple offers, that here's the accepted offer price, and even noting that the buyer is obviously getting financing, so we need a lifespan on this home of 30 years in order to qualify for a 30-year amortization.
The better, as a listing agent, the better the sale price I get, the more paranoid I am about the appraisal. So the more likely I am to be there for the appraisal and share, oh yeah, we had 5 offers and this was the number and here's your comps if needed. Just make sure that appraisal goes well. Because even if the buyers remove subjects, the deposit's in, the place is sold, if that appraisal doesn't go well, you're going to get an unfavorable surprise, or you're open to risk. And even if you're on the listing side and you're like, well, it's not my issue, it is your issue if they can't close when it comes time to close. Avoid headaches. Help that appraiser out. There is the option of getting a second appraisal if the first one doesn't work out. I've seen that before, but it's a little scary. We're talking about the houses with the condition of the house, the grow up. A high purchase price, like you said, Denny, if you're paying way more than it's appraised at, that can affect your loan. And for condos and strata properties, sometimes the bank will request additional documents. They might want to see depreciation reports, engineer reports, Form B, AGMs. And a major assessment or work being done on a building could affect its lending. If there's a leaky condo or a parkade membrane coming up, or you name it, that comes with a $50,000 or $100,000 assessment, that could affect a bank's ability to loan on it.
Even if a seller is paid that assessment, let's say they did a parkade membrane and it cost that unit $25,000, in the middle of the project, some banks have a problem lending during that project because they don't know if it's going to go over budget, if that buyer is going to have to contribute another 10 grand. So in a major project for a building, it can be difficult to get lending halfway through the project.
Absolutely. And I think just lending right now in construction is tough. It is expensive and it is hard to qualify, and a lot of banks aren't doing it. Denny, we talked about pre-approval versus approval. We talked about stress test, touched on mortgage payments. Hard to make money as an investor right now. One of the headlines I saw out there is investors are losing money. They're like, cash flow is not good. I mean, of course, if you locked in a 1.8% 5-year fixed mortgage rate, you're sitting pretty, but cash flow is hard to find right now. And it will come back one day, but well, yeah, it'll be better one day, but it's tough. Rate holds, again, when you get the pre-approval, 120 days. Right now, we're in that period where the rates were better before than they are today. So that could be part of the story behind the market we're seeing right now. We'll see how many transactions happen in the fall with 5.5% rate holds. So, but anything else that comes to mind from your end, Denny, on financing in today's world?
I think we covered a lot of it.
Number one thing is talk to a mortgage broker. And if you don't have one, we happily recommend you some great names. Someone that just does mortgages, that's their specialty. They understand the urgency of it. If you bank with a bank and you just like going in and talking to the account manager that does a bit of everything, recognize that they might not be able to get you qualified in the short time you need to while you have a pending offer. Sometimes your offer has 3 days or 5 days to remove subjects. A good mortgage broker can make that happen. But if you talk to an account manager that does it all, they might say 2 weeks, no ifs, ands, or buts, and that could jeopardize your deal. So feel free to reach out if you need any recommendations on a mortgage broker. You can email Denny direct or myself. Denny's at Denny, DENNY, at gdrealestate.ca, and I'm at James at gdrealestate.ca.